Today, we are going to dive into the 3 fastest steps you can take as an entrepreneur, business owner to accelerate your company's success, protect your current position, and increase your revenue without adding any more clients or selling any more products. We do that through efficiency. I remember reading a lovely book on my shelf here where a gentleman was talking about the idea that when 2 vehicles are sold, let's just say I have an F-250 that I drive. It's a diesel. It was around $78,000 on the lot. Thankfully, there's no loan on it, cash purchase. But another gentleman most likely bought the same exact truck. Why is it that some people can get, with these trucks, you can get 500,000 miles out of it, and then some people only get 100,000, 200,000 miles out of a vehicle? What is going on there? They're both made same factory, same people, same components. Yes, there's recalls, but let's just pretend it's all the same. The difference is, let's just say I can get 500,000 miles out of mine without issue, while somebody else may get 250. The difference is in how we use them, how we maintain them, how we set up maintenance schedules, how we treat them. Now, yes, there's variabilities. Maybe that guy uses his for a ranch and he's beating it up every day. Maybe I'm using mine to tow things, heavy things, spend time with my family, go on hunting trips. So assuming that we're even, I'm going to use mine for city stuff and the other guy is too. The difference is the people. And Mises writes, in human action, humans are all different. I may rotate my tires at every oil change. I may stay on my maintenance schedule. I may change the air filters, as to where somebody else may say, you know what, I can go an extra 2,000 miles. I don't need to get an oil change. Well, in business, we can do the same things. So when we have 2 businesses, why is it that most businesses fail? Now, there are bad ideas. Maybe a time hasn't come for your idea. Maybe some external reason. Not every business fails for lack of knowledge. Sometimes it's just the way the market picks and chooses. And Polaroid went out of business because of a digital camera. Well, that was time. So that being said, looking at, let's just say most business owners, they have products, they have services, they have employees, they have market share, they're doing good. But why is it that some people who make $500,000 a year, let's just round number, say $1 million a year, at the end of the year, somebody has more money? We're going to jump into that today, and we're going to jump into the iPad, go out for some strategy, and look at what you can do today to make your business bulletproof. You, the business owner, obviously, I'm going to assume you're running a very successful company. I'm going to assume you're doing over $1 million a year profit. And, a lot of times I make the assumption that a lot of business owners are already doing these things because I am, because a lot of my clients are. But, like this last week, sitting down with a business owner, their annual tax liability was about $1.2 million. And they do very well. They have a great business. And I got tapped into the conversation in their business because of their frustration with their current accounting firm, their current tax strategy, their estate planning strategy, and their asset protection strategy. And he just said, dude, as well as we're doing, we don't have good communication with our teams. We're disassociated with our legal and tax and finances. It's kind of hodgepodge. And you guys, that is the purpose of a virtual family office or a family office in general. And so real quick, I'll give you the breakdown. So a family office is a family that individually hires people just for the family. Very big threshold to break into that. You're looking at spending a couple percentage of what you make as a family every year to employ your own accountant, your own lawyers. And that historically was like what the Rockefellers did and popularized. Now, then we have what's called a multi-family office. So you have the family office, one family. I think of a NASCAR team. And then you have a multi-family office. And a multi-family office will take on 2 or 3 families. And so they're kind of put in place. We have our team, and then we'll go help a couple families, or maybe 30 families, depending on their bandwidth and their team. And then you have what's called a virtual multifamily office. And with the advent of technology, the ability to cross communicate over different platforms, Zoom, document uploads through the web, a virtual family office can take on a client in Louisiana. Like I'm in Arizona, so we can take on clients in Florida, all over the place. I have a call tomorrow with a gal from LA in her business. So a virtual multifamily office is the ability to virtually bring on businesses and help them structure, alleviate their pain, make everything congruent, which hopefully allows the founder or the family to focus more on what they want to, not having side conversations and being scattered with the CPA over here and everybody different over here. And we're selling real estate and we're acquiring another business. You want to centralize that as much as possible. And that's the art of delegation. So that being said, this gentleman, sat down last week, family business, stay in the family, which I absolutely love. These kids don't have to start over. They're going to go and they have scaled their father's business. They're employees of the company. They have no equity, and they're eventually going to inherit that company from father. And so my goal with the father is to centralize all of his planning, his assets, his tax liability, his estate planning, button that all up, put a bow tie on it, meet with him quarterly every year to help him a lot of that stress. So, but there's super easy things to do that I will give you absolutely for free. I'm not going to sell you anything or ask you to reach out to us. I just want you to have this information. You can use other people to establish these things that I'm going to share with you. You don't have to, use our fastest path right now into your business with what you're doing. So jumping over to the iPad. So the fastest things we can do in our businesses right now as business owners. So the first thing that we can do is tax planning. So if you look at a balance sheet of a successful company, you will see that their largest expense is usually their taxes. And so what is tax planning? Tax planning is a lot different than tax preparation or just, I have a CPA. My buddy from college, my neighbor, or the down the street guy. And in that conversation last week with this new business that I'm taking on, I said, can I just ask you how much a year you pay for your tax planning? And they were going off on him. Wow, they can't get back on an email. We told them we're buying a building and they haven't even got back with us, and we want to make sure it's titled correctly and everything's on the up for taxes. And I said, well, how much do you guys pay? And they said, well, it's $1,000 a year. And I said, what do you think about that? I said, for an annual tax liability of let's just call it $1 million, it was a little more. I said, do you think paying $5,000 for a service when your tax liability is $1 million a year makes sense? And I said, what if I told you guys I was going to get a brand new truck rebuilt, and I was going to get all my welding done on the truck to fix it for $1,500? They'd be like, you're not going to do anything. And I said, look, guys, I'm not here to do. I'm just telling you that you need to start looking at your investing in a tax planner as an investment. And in our world, the juice has to be worth the squeeze. So the question becomes, would you pay $100,000 a year? That's not what I'm saying the cost is. I said, but would you pay $100,000 a year to a tax planning firm who's very astute with high level corporate taxes and estate taxes and trust tax planning? Would you pay them $100,000 a year if they were able to reduce your tax liability by 50%? Absolutely. Would you pay them $100,000 a year if they could reduce your taxes 80%? Absolutely. Well, how in the heck did 22% of Fortune 500 companies pay zero in federal income tax? Most recently, the owner of Patagonia sold his, I think it's a $4 billion with a B, $4 billion company. And I believe the tax liability was sub 100 million. 4 billion, taxes under 100 million. I think it was actually lower than that. You'll have to look at the story and see. The American College of Estate Planning did a breakdown on that. Very interesting. The use of trusts and a foundation and some trickery, elite planning tools. And so that's how we have to start looking at our tax planning, just like you would a vendor. Our vendor if we give them, they're going to make us 400,000. That's a great ROI. If you're running ads and you're sitting down with your marketer, you want to know, how much am I spending to acquire a lead? Tax planning is looking at what is your structure? Are you a C corporation? Are you an S corporation? Should you have a C corporation bolted onto your S corporation? So you can maximize deductibility in the S corp for what's legal and lawful, maximize deductibility in the C corp that's legal and lawful, and now you have some veils put in place for protection. So how is our business taxed? The other thing, should we be paying our children? We can pay our children $14,000 a year. It changes, so depending on this video, but they allow you a year to pay your children in your business. These kids that for this welding company, they've been in the business since they were kids. Has he been paying them 14 grand a year? So in that scenario, let's just say you're sending your kids to private school. That private school's 10 grand a year. You have to pay taxes on the income that you get to pay for them to go to private school, plus their sports, blah, blah, blah. Let's just say that's 15 grand a kid. That's your expense. It's probably more if you're doing club sports. But what if we could integrate the kids into the business, pay them $14,000 a year, and then their debit card can pay for private school, can pay for hockey clubs and sticks and golf clubs. And so there's more strategic ways. And so we have 4 children. So what does it look like for me to pay 4 kids, $14,000 a year each, times that by 15? You're talking hundreds of thousands of dollars, you guys. So that is what tax planning is. It is sitting down, looking at your corporate structure, looking at, do you need to set up, trust planning, estate planning? How are your kids? How are they structured? What happens if you're in litigation? And so that gets into asset planning, line number 2 here. Asset planning. So we just went over tax planning, which is obviously very surface level. And so what is asset planning? Asset planning is, what are the current assets we have? I sit down with businesses that have $1 million in their business checking. It is crazy. So in litigation, if somebody comes to sue your company, all that money is locked up, absolutely locked up in discovery. Can't move that money around. And so what does it look like to shift assets out of the company to give you more flexibility in the event of lawsuit, in the event of bankruptcy, in the event of something bad happening? And so asset planning, what if we shift that money outside of the business, protect that money, and let that money grow outside of our names? So now we're looking at more tax planning, okay, which also rolls right into estate planning. So now we have our companies doing very well. We're very efficient. We're taking all the legal deductions in our S corp, in our C corporation. We have an estate plan set up. We're paying kids appropriately. We're maximizing all the deductibility of equipment and depreciation and real estate depreciation. And if that's not something, we had an accountant about a year ago, electrician client of mine, he had bought a commercial building. And in that same year, he told me, yeah, we're going to pay about $45,000 in taxes this year. What? I said, you just bought a $1.5 million commercial building. That doesn't sound right. Further detail, looking in, coordination with our tax planners. His tax planners said that depreciation was illegal. I'm not throwing stones at anybody. We sat down with his CPA and said, hey man, let's back up. It's not illegal. It's actually negligent that you're not using these, this part of the tax code for you do it. So we helped his accountant out, showed him the code, the schedules, how it works. Now that client was able to go back, amend his tax return, and claw back money. So estate planning. So yes, we already got into tax planning. The number one thing we do is we optimize. We optimize the business, we optimize the family, and look at the overarching, excuse me, we look at the overarching big estate. Okay, how does all this get set up? So we optimize the business, optimize the family, and optimize the estate planning with trust planning, and potentially sometimes a foundation, depending on the nature of the family. If they are charitable, if you're not charitable, don't set up a foundation. That simple. Asset planning. So here we did with the electrician company. We actually ended up about $1,000 out of the business, putting that into high cash value life insurance. So he remains liquidity year one. So whatever of this 400 he put into life insurance policies, he had about 90% liquidity, which is very, 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 very strong. And so that was pretty interesting. Him, we have a wife and then 6 kids. And we spread that 400K. Actually, we spread about 350K down over the family and built out life insurance policies, the entire family. So very young kids in there, and then some, teens in there. And so instead of doing 529, those kids may go to college or may not. And it sounded like some of his kids are going to work into his business. So college wasn't going to benefit them as much as just staying in the business and learning the business from dad. So that was asset planning. We took 400K, put it into the life insurance, and then annually, I believe the annual premiums were about 35K on everybody. So not really an episode of going into insurance planning. It is by far, as a business owner, top 3 tools you must be using. 1, to clear debt if you die for your family. 2, to maintain liquidity into the company. And then simultaneously, you're buying stuff for your company anyways. So right now, to borrow money from a life insurance policy is about 5%. I'll just call it 5.5 right now %. And that's simple interest. And when you take the loan from the insurance contract and put it company as a loan, document it as a loan with paperwork, you control the business owner. So you have flexibility. When you take that loan from the insurance company, you don't have a repayment schedule. You pay it how you can. Massive flexibility. And right now, that's pretty cheap money. So for auto loans right now, you're looking at upper 9-10% for an auto loan. We're just shy of half of that right now using life insurance companies. So I'm 37. I grew up in the time of easy money. 3% money, 4% money, 2% money. I've got some friends with some 2% mortgages. So those days are gone. And so you have to look at this business planning from a historical perspective. Easy money wasn't going to be around everywhere. Alan Greenspan came in and just started lowering interest rates. We're back up to very high interest rates. Some people say, well, yeah, in the 80s it was 20%. That's the equivalent of where we're at now. Because in the 80s, at least your dad made a really good paycheck. At least the common middle class was doing well. They made good salaries. Their income was great compared to the assets around them. Now what we have is high interest rates, high price to get out of Costco, high price for university. I mean, from 1998 to 2002, that 4 years, if you went to ASU to get a bachelor's degree, it was about $14,000. So people say, well, our rates aren't that high. And I know I'm beating a dead horse here, but it's not an apples to apples comparison. To go to 2%, to 4%, to go to 6%. We're looking at more and more. And so a different dynamic now. So as the business owner, you have to either have a team supporting you, helping you navigate this, or you've got to step up and learn as much as you can, be as sharp as you can, and have as much attention as you can. So that being said, moving on to estate planning. So estate planning is very interesting. I'm very thankful that I have an amazing mentor who was able to introduce me to what real estate planning looks like. So with estate planning, you have what's called a living trust, or you'll hear it called revocable, and then you have called irrevocable trusts. Now, this revocable living trust gives you zero asset protection, asset pro, gives you zero tax planning for the year, and it gives you zero anonymity. The family I sat down with, who owns a welding company, yeah, we have a trust. I said, you do? I said, how much did it set up? Oh, it's like $4,000. Instantly will tell you that that's a revocable living trust, just by price. I said, what do you about that? I asked him, I said, are your assets protected in lawsuits? He goes, yeah, they're in trust. No, you guys. So backing up a little history, colleges, law colleges teach law used to make estate one of the major core learnings of a lawyer, of an attorney. Well, they've removed that. So very few people now are actually colleges educated in estate planning. So now it's pretty much if you go to college to become an estate planner. Well, the estate planners coming out of college are only learning about revocable living trusts, like I just told you. No asset protection. And the reason is because you can take assets in and out of the trust. You control it. You have ownership in it. Let's go back to the main screen and we'll wrap up here at estate planning. So living trusts give you no asset protection, no tax advantage in the current year if you're alive, and they give you no anonymity. So when a lawsuit is presented, let's say you send your kid off to college, or let's say, everybody has a dog pretty much. Let's say your dog, you have neighborhood barbecue and your dog is eating a food bowl and the neighborhood toddler walks over and your dog bites them in the face. Let's just say there's a big scar. Well, the family is going to sue you. Now, they're going to go after the insurance policy, the homeowner's policy first. Let's just say the homeowner's policy covers 200 grand. And you look at your kid and say, my kid's nose is jacked up, their face is jacked up. I'm not happy with 200 grand. I want $1 million+ for the damage of my child. Well, then they're going to go, okay, the attorney's going to say, let me look at their assets. Let me see what they own. And they're going to look at you and say, oh, wow, he's got 5 single-family homes. He's got a position in an investment for his brokerage account. His personal brokerage account has $1 million. $1 million liquid. And looks like they have about $1 million equity in their home. That attorney is going to tell the client, I'll take on the case for you because he knows he's going to get paid on the back end. And that's with living trusts, okay? It's all yours. You own it. So you need to raise your hand in discovery and say, those are my assets. I can take them in and out of the trust. Therefore, you own it. Now, on the private side of using irrevocable trusts, those assets get sold into trust and out of your name. Totally separate thing, has nothing to do with you. Those assets are legally on paper not yours. And so when they're coming to sue you, whether that be your business or whatever dealings you're with, you can legally say, I don't own very much. You sell your house over to a trust, you don't own that house. Now, some of the trust provisions have what are called spendthrift provisions, which protect the assets of the trust for the beneficiaries. And with spendthrift clauses, there's a ton of court cases where people have tried to penetrate the trust to get the assets and the courts have not turned over those assets. Now, they have in cases of divorce or child support, very few minor cases. But as far as asset protection goes, there is a significant benefit to using the irrevocable. And so not all law firms participate in those. If they do, they use a weak form of irrevocable. And so, we've worked hard in our virtual family office to partner very, very high-end, very strong estate planning firms to asset protection from the personal level. So that being said, recap, and then we'll hop off here. The 3 fastest things that you can do in your business is entail in tax planning. Tax planning, tax planning, tax planning. These are people who maybe 1 in 20 CPAs actually really know the depths of the full tax code, massive loopholes, and the ideal, most expensive, best version is a tax planner who actually will sit down with your estate planning attorney, coordinate all together, get assets out of your name, protect your estate, protect the beneficiaries, protect the assets. The second thing we could do is look at our corporate structure. How is our company formed? Are we the most efficient? That can come from the tax planning, absolutely. Not always, but that's where you start to look at, okay, we're an S Corp, we're maximizing those deductions, we're not paying employment taxes. What happens if we bolt on a C Corp? First, what is the expense of that? Is it worth the squeeze? Is it worth spending $5,000 a year to have a C Corp compliance, maintain everything with the C Corporation, to get another deductibility of, let's say, another $50,000, $60,000 of legal deductions? And then from there, tends to bolt on a very bulletproof estate plan for the family for long-term wealth, where you don't have to worry about those assets being taken from you in divorce, litigation, bankruptcy, lawsuits. So those 3 things. I hope this video is very helpful for you as your journey as an entrepreneur and business owner, no matter what stage you're in. I hope this was a blessing, and we'll see you guys on the next video.